FX Nation, what's up, guys? Welcome back to ForexU and our advanced course. And guys, in this video, we're going to go ahead and we're going to talk about market maker trap moves. And we're going to break this down into a couple different videos, maybe 2 or 3 videos. If not, this would be like a 3-hour video. So we're going to go over what are the market maker trap moves in very specific detail, different type of patterns and stuff that we can look at to help identify what are market maker trap moves. So without further ado, guys, let's jump right into this and let's start this part 1 video on the advanced course. So let's talk about market maker trap move, guys. So the first thing is we're going to talk about trap candle patterns. Okay, there's going to be 3 major things that we're going to cover in the series of videos when we talk about market maker trap moves. The first one is the trap candle patterns. Okay, the second one is going to be the dealer structure. What is the market maker structure that can help you identify these trap moves, so then that way you can understand what's going on and what they are doing. And then the third is to understand market maker behaviors. Okay, if we know what their behaviors are, essentially that gives us the edge that we need to trade in line with them and not against them. All right, because a lot of times, we don't realize as retail traders that we're getting trapped or we're getting duped by market makers to induce into basically going into a trade. Okay, because at the end of the day, guys, that's their main job, is to try to convince you to get into a trade. Okay, because they cannot make money if you're not in a trade. All right, so their whole job is literally to put fear in you and fear of losing out, fear of loss, right? And get you into that trade and get you into the live market. Once they get you into the live market, that's all that they need. They'll handle the rest, essentially, right? But if we know what their behaviors are, if we know what to look for with their structures that they build out with these market structures, and if we know these trap candle patterns that they essentially put out for us, then we know exactly what their behaviors are, what they're doing, what their way of thinking is, and essentially we can go ahead and trade with them. All right, so let's get this started here, and let's talk about first the half a bat setup. Okay, so what is a half a bat setup? Let's talk about this. So the half a bat setup is a pattern that can happen in any time frame. So it could happen on a daily, it could happen on an hour, it could happen on a 15-minute candle. So it depends on which time frame you're looking at, as far as, obviously how long it'll take to develop and things like that. But for this instance, let's talk about it in the form of it developing on a 15-minute time frame. Okay, so market makers, basically how this pattern forms is market makers spike the high or the low of the day, essentially as a way to set up the session, right? So let's talk about let's say a spike that happens outside of the Asian range, right? We get a spike that suddenly goes up or goes down from the Asian range, and that's basically them to spike the high or the low as a way to set up that particular start of the session. Market makers are now trading off of that level. So basically, once they spike that down or spike that up, you'll see them pull back and then literally start to move sideways for the rest of that setup. Okay, and then the third thing is market makers will not repeat that same level again. So essentially, they're not coming back up for a second leg to retest that. Okay, because doing so will essentially release all the traders that they have trapped. All right, so one of the biggest disadvantages that we don't know is we don't know essentially how much money they have trapped and what their average goals are for the day, right? So we don't know that. So that's a really bad part that we don't know. Just like we don't know how long they're going to hold out a level before they move up to another level. right? So when we talk about this, and this particular pattern is essentially what makes it very distinctive, is that there is a spike up to make a first leg of an M, and then they come back down, and then they literally move just straight sideways. Okay, they don't consolidate, they don't move down like a normal M pattern would. Okay, and you'll see what I'm talking about. I'll show you plenty of examples so you know exactly what you're looking for on this particular pattern. But they won't come back up to meet that second leg M that we look for. Okay, and then price literally just appears to just roll off that level. Literally, it just rolls off like a cliff, right? So it spikes up, goes straight sideways, and then it just rolls off a cliff. Okay? So some rules to consider. The first thing is the sideways movement needs to be about 15 to 25 pips from the high or low of that day. So when the market makers move and create that spike to make that first leg, and then they come back down again, and then they start moving sideways. When they start moving sideways from that particular moment to the very top of where they spiked the high, that should be anywhere from 15 to 25 pips. Okay? That's where you need to be essentially within that range for this to be an accurate pattern of a half a bat. The next thing is, that market makers, of course, they won't come back to retest that previous high or previous low. Why? Because then they'll be able to allow profit taking from the traders that are trapped. Okay, so in this case, they don't need to go back up, essentially to retest that level, right, to get more traders in, because they already have enough traders trapped. Okay, and all they're doing is literally just moving sideways, collecting contracts, and then it just literally falls off a cliff. All right, so let's go ahead and take a look at some examples so we know what we're looking for. So let's take a look at the examples that I picked out here for you, so you can see what this half a bat pattern looks like. So the first one here, you can see market makers basically make a move straight up, right? You see them create the high of the day here, and then you see them move off of that level and literally, like I said, move straight sideways. And then price literally just rolls off. You see that? So that's where it creates that half a bat pattern. So you get the spike up, going back down, 15 to 25 pips from the high here, and then it just moves sideways. Now, sometimes the sideways movement, guys, is going to be, maybe 7 candles. Sometimes it could be like this. Okay, but I'm going to show you a bunch of different examples so you know exactly what you're looking for. Okay, so this is it right here. All these, by the way, all these examples were pulled off the same chart, Euro Pound, just off of one chart. All these examples within the last month. Okay, so this is one of them right here. Okay, here's another one. You can see this is the Asian range here. They spike up. You see that? And then now they move sideways, and then literally it just rolls off. Right? So this is what I'm talking about. Spike up, consolidate 15 to 25 pips from the high here, and then they just move sideways straight, bars, and then they just drop off. Here's another one the opposite way, right? So they spike down. Here's the Asian range here. They spike down. They create the spike, move sideways throughout the whole session. Look at this. A whole setup throughout the whole session. Now, this right here is basically the previous day. They spike down. They come back up, and they move across the entire Asian session. And you see the setup actually happens when? The setup actually happens during the London session right here. Okay, and you can see basically this is the middle of the range right here. So this is essentially a type 3 setup that goes up, right? But you see essentially the setup that provides that for you is the spike down, come back up, 15 to 25 pips, and then they just move sideways, 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 and then boom, they take off. Here's another one, and essentially you can see here the spike goes up, they come back down, they move sideways, and then they spike it down, and it just rolls off. Okay, so you'll find different patterns, different variations of this. That's why I'm showing you different examples of what they look like. So here's another one. Spike up, come down 15 to 25 pips, literally move straight sideways. Okay, and I think the dead giveaway for this, guys, is the fact of this sideways movement. Okay, you know, on a regular, you know, let's say M pattern or W pattern, right? You get the movement down, and then you get the movement right back up, right? On these patterns, you don't get that. The biggest way to tell, guys, is literally this sideways movement of just candle after candle after candle after candle, basically stuck in a little mini range. Okay, that's your major clue right there. All right, and then you'll see, of course, that the 5 and 13 are pretty much riding along together, right? And then boom, you have the cross, and then it drops. So this one here happens after the London session. You can see the spike happens right from the London. And then this is the box here that ends the London session for us, right? And we get into that 7 o'clock time range. Well, here's the spike up, moves sideways, sideways, sideways. And then right when they get to the US session, there's your move away. Okay? Like I said, there's different variations, but essentially it's all the same. Okay? Some candles will be 6 candles, other ones will be 7 candles. You just don't know. But you'll know that essentially we're still looking for what to happen within that box, right? So this has all these moves here. When we talk about trading in the 15-minute time frame, these moves still have to happen within that box. Okay, so we're still following the rules that we know, which is taking the trades only that happen inside of that box. So we still have to take those trades within that box, guys. All right. So a couple things to consider with this particular pattern, guys, is number one, if you're going to enter this pattern, okay, we still want to make sure that it's within inside of that box, either inside of the New York box or the London box. Okay, that we still want that as, because that's our form of confirmation, right? We still want to have the 5 and 13 be there. Now, you may not necessarily have to wait for a crossover on these because these don't work the same way. Essentially, if we look at some of those examples here, a lot of times a crossover will be there already because, you know, price is already moving sideways and it basically gets the 5 and 13 to be together. So the problem with saying, okay, well, you can take it when there's a crossover is the fact that the crossover is happening multiple times when this type of pattern develops. Okay, so you can't just wait for a crossover. Okay, you have to essentially wait for the pattern here to break essentially that structure, that initial structure that it creates, right? So basically you can make a line here and a line at the bottom. As soon as it breaks that line at the bottom, you can enter the trade. You know, so say in this example here, you're creating basically a line here and a line here, right? And now on this particular example here, when we're looking at this, you know that this is the Asian range, so you know you're not going to get in it, you know, back here or anything like that. You're gonna have to wait till the Asian range ends, right, to get into the trade. But here you can see that after the Asian range is over, you basically get, you know, a type 3 pattern here. And then on this one, the same thing. You see how the crossover had already happened, and basically you're still moving cross. So you're waiting for that, basically that bottom to break. As soon as that bottom breaks, you can take that trade. Same thing here. You draw a line from the bottom here, top here, And as soon as that bottom breaks, you can take the trade. Same thing here. Here's your candle set up. You're drawing a line here and a line here. As soon as that line breaks, you're taking the trade. So basically in this candle is when you're taking the trade. All right. So guys, that is a half a bat pattern. It's pretty simple. I would always recommend, guys, going and back testing it. All these examples, by the way, were just on euro pound. Okay. And like I said, there will happen. It can happen on any kind of time frame. So you will see these on a daily. You will see these on an hour. You'll see these on a 4 hour. All right. The important thing to remember, guys, is the actual spike up that happens, followed by the move, off of the high and straight movement sideways. It's a very distinct pattern, guys. It's a very distinct pattern. Okay, that you will, if you start looking for it, you'll see it. All right, but it's a very distinct pattern that happens in the market, guys. So I hope that this will allow you to just recognize a different structure that you could see essentially while you're watching for, let's say, a type 1, type 2, type 3 setups to happen. If you spot this kind of a formation happening, guys, you know essentially what to do. All right, guys, until part 2, guys, thank you so much, and have a great day.